Ladies and gentlemen, my name is Mr. EMEKA. Today I'll be taking you on accounting, and the topic we have today that I want to take care of is the meaning of subsidiary books and major rules of posting into subsidiary book, especially cash book. If you look at what we have on the board, I have just listed the various subsidiary books we have, and you can see it here. Then the first one we have is cash book. The second one, purchase day book. You can call it journal if you like. Sales day book, return inwards day book, return outwards day book, and journal proper. Then these are the rules that I've leveled out and stated out. All these rules are to be read and be taken care of. Now let me take care of this first. First of all, the first thing we are going to try to find out is the meaning of subsidiary books. What are subsidiary books? We can also call them temporary books of account. Yeah, subsidiary books are temporary books of account in which the books, the business transaction are initially recorded before they are taken to the principal book of an account, which is ledger. The ledger, before they are taken to the ledger account. This is the principal book of account. It's the main book of account. While all these are the pre-books that are the subsidiary. That's why they call it subsidiary books. Subsidiary. It's not for permanent purpose. They are just there so that they can be transferred to the ledger account. Now let me give you a brief meaning of all these subsidiary books. The first one, cash book. Cash book is a ledger account. Yes, a subsidiary book, but also a ledger account in which all cash transactions are posted. All cash received and cash payments are posted. Or any transaction that has to do with cash is being posted in the cash book. The cash book will have four major types of cash book: single column cash book, double column cash book, three column cash book, and petty column cash book, or you can call it petty cash book. The next one we have online is purchases day book. Now, purchases day book is a subsidiary book in which all goods that are bought on credit are recorded. All goods that are bought on credit are recorded. And all these transaction in accounting, due to the accrual concept that allows the recording of credit transaction irrespective of whether money is being paid or not. The day the person who came to patronize the business gives his intention and he collects the goods, it is being recorded as the date of sales, not when the person pays. That is what accrual concept is. Because of this, that is what gave rises to all these other subsidiary books. Purchases day book, this is where all goods bought on credit transaction are recorded. Sales day book, this is where the subsidiary book where all credit sales or goods that are sold on credit are recorded. The return inwards day book, this is where all damaged goods which are sold out that are returned back to the organization are recorded. Same thing the other way around for return out was goods that are bought, those goods that are bought on credit that are damaged, when they are sent back, this is where it is being recorded. That's the return outwards. Then we have the journal proper that accommodates every information that you have in purchases, sales, return inwards, and return outwards. The journal proper accommodates it. From here to here are all on credit transaction. Now let's go to the rules of posting into cash book. There are so many rules, but I can highlight the most important ones, which are the three rules I have here. The first one is all incoming cash or cash receipts are to be debited. The cash book has two sides, which is what? The debit side and the credit side. This is a ledger, but let me just use it as an example. Even the cash book on its own is also a ledger. Now, the cash book that has the debit side and the credit side, which also have the dates, particular folio, amount provision for both the debit side and the credit side. We have different types of cash book: 2-column cash book, 3-column cash book, Yes, we have different types of cash book. We have 2 column, 3 column, 30 column cash book, 1 column cash book. All of them, they must have the provision of they must have date, particular folio, and amount. The difference between the 1 column cash book and the 2 column cash book is the provision of the bank. So the amount now is divided into two, cash and bank. And 2 column cash book are used for bigger enterprises or businesses. Then the same thing goes to the 3 column cash book. Provision was made for what? Provision is made for the discount received and discount allowed. The discount allowed is found at the debit side because when you sell, you allow discount, and discount received is found at the credit side because when you buy or you purchase, you receive discount. So all cash receipts or incoming cash are debited, are posted at the debit side. Then the second rule is all outgoing cash or cash payments are credited. All outgoing cash or cash payments are credited. The third one is balancing, the balancing of accounts, which is very, very important. So many students find it very difficult to balance accounts. If you follow this rule, this simple rule I've given to you, it is going to be a thing of the past. The difficulty is going to be a thing of the past. Now look at it. Both sides, debits and credits, are presumed equal in order to ascertain the balance by acknowledging the law of double entry. Now, what does that mean? The law of double entry states that for every corresponding credit side, there must be a corresponding debit side. So if you must balance an account, you have to presume that both sides is equal before you can now get the balance. When you get the balance, you can now know whether it is a debit balance or a credit balance. Now, this illustration I use here, I want to use it to explain this last point. Look at this illustration here. This is an account for Mr. Obi. The first two initial posting is this: cash 100 and bank 50. These other ones are not there. So look at this 100 now and this 50. You can see the 100 is bigger than 50. Now what do? You just leave a space here because here is smaller than this side. You put what? A balance carried down to complete it, this 100. So having done that, you see that if you add 50 to 50, it will give you 100. So you now use zigzag and make sure that both of them are 100. You can see that both sides are presumed the same. You can see the total of the both sides is the greater side, which is 100. That must be the same with this side. So that is how we are able to ascertain the balance. The balance between this bank and cash. This debit of cash and credit of bank. You see, the balance is 50. So the balance carried down is written to complete the lesser side. In order to make it balance with the other side, then a zigzag is put here so that no other information will be written under it, to ensure that the place is locked and you know that yes, the only transaction we have at the debit side is 100. Then after writing this balance carried down here, you have to repeat it under the greater side as balance brought down. Now this is how to balance. This is a simple way to balance. First, presume that both sides are equal. You can see that both sides are carrying 100, 100. It didn't carry 50, 50 because 100 is bigger. So this is the rule of balancing. Now there is a particular rule that I skipped here that I input, is contra entry rule. I'm going to take care of that one whenever I am into the various cash book lessons. Then I'm going to teach you more of contra entry when I'm treating 2-column cash book. On this note, yes, that is it. So please don't forget to click the like button, share, subscribe to get more of our educating free videos. You know, we have so many of them in different aspects. The science, the commercial, the art. Just follow us up, click the like button and subscribe, and remain blessed. Bye-bye.